Industries that are hot, sectors set to outperform the market. That's what's here in Zacks Industry Rank Analysis. Bet you tuned in just to find out which industry we talk about this week. Well, we're not going to keep you in suspense any longer then. Let's bring in Charles Roplet, our senior market analyst at Zacks.com, because on his radar for this week is retail once again. Circling back to this area here, we've had the consumer confidence numbers come out yesterday, the 26th of May. We taped this on the 27th. Showed an upturn, but you say that that's not all what it's cracked up to be.
It's not, and it's important to understand the Consumer Confidence Index for the Conference Board. We have two of them, the University of Michigan and the Conference Board, and specifically the Conference Board's numbers came out the day before we record this. May 26th is when the data was released. It's based on an index of, I believe, 1985 is the year. It might be a year or two off, so please don't hold my feet to the fire. But basically, it's an index of 100 as the base, and so anything over 100 is considered good, anything below 100 is considered bad. Right now, the index was at 54.9, so it's not just a little below, but it's far below. Obviously, you're looking at 98 versus an index of 100, well, people are a little less pessimistic than the mid-80s. That's not such a big deal, but 54 is a huge difference. So what we're seeing is consumers are still generally pessimistic. So although we did see an improvement in consumer confidence, and that's a positive, consumers by and large are still pessimistic. They're still worried about the situation. In fact, 45% of people describe jobs as hard to get. So consumers are looking at it still skittish. What was very important about this number, however, is that expectations for the future rose dramatically, a 21-point jump in what people thought, and that's a sign that a lot of consumers might think the worst for the economy is over. Doesn't mean blue skies ahead, but it does mean that they think they've survived the worst and that things will improve.
So what about retail caught your attention besides that number?
Well, the other thing that's caught my attention about retail is we're continuing to see estimates being revised upwards. And out of all the sectors, retail is the strongest sector. We're seeing 3 earnings estimates revised upwards for every one that's cut. So a very big revisions ratio. And what's behind that really is a combination of better than feared numbers, both in terms of same-store sales and in terms of earnings. And behind that, we're looking at inventory control management. And really just going back to that same-store sales number where we're seeing more people come in than people thought would. Not great. A lot of retailers are actually reporting declines in year-over-year sales. And so you have to look at it. Yeah, the numbers are better than we thought, but they're not really good. However, they're good enough to have analysts take another look at the forecast and realize things aren't as bad as I thought they were. And this is notable because about a month ago, 6 weeks ago, we were having the same conversation about how analysts were raising their forecasts on retailers. So this is an ongoing trend that where at the very start of the year, analysts were probably too pessimistic on the retail sector, and now they're being forced to revise their estimates upwards. But I think it's important for people to realize that, yes, we have this positive revisions, and that's bullish, but the retailers are not out of the woods by any shape or means.
I was going to say, I still see analysts on the wire saying that a lack of available credit to retailers is going to force more of them to close. I mean, more and more of them to close by the end of this year.
Well, it's interesting. One word I saw a lot in terms of the earnings reports and looking at the conference call transcripts was challenging. And I'll quote here the CEO of Kohl's. He said the consumer will be reluctant to spend. The CEO of Gap said in a different conference call, the market conditions from our perspective continue to be challenging. So again, there's 2 different retailers really describing conditions as being tough, and it's a common theme throughout. Nobody's really looking at, well, I should say nobody, very few retailers are actually looking at the environment right now and saying business is good. Most CEOs are saying business is better than we thought it would be, but it's still not good.
So the change in earnings estimates among the retailers is, you're saying, a predictor of better things ahead?
Well, I think in this case, what it's actually signaling is that analysts were too pessimistic, and so now they're being forced to revise their estimates higher. Since versus being optimistic, it's really okay. Things aren't as bad as we thought, and the reason why it's positive for a stock, if you thought a stock was going to earn $1 this year, you might say, okay, the stock's worth $15 because I expect earnings to be worth, $1 per share. That 15 PE ratio. Well, all of a sudden, instead of being $1, you say, okay, I actually think earnings are going to be 20% more, so $1.20. All of a sudden, that P ratio, if you want to keep it at 15, you have to raise the stock price 20% to about $18. And so therefore, you're seeing the stock price rise. Now, granted, earnings a year ago might have been $2, and 3 years from now, they might get back up to the $2 range. So you're still seeing that drop in per share earnings. But when you look at what forecasts are now versus what they were just a couple months ago, you're seeing the P multiple actually, if it stays the same, you have to adjust the stock price up. So again, if you look at the P ratio, you have the price and you have the earnings. And then if the earnings number itself gets revised upwards, then either the price needs to go upwards or you're looking at the multiple itself coming down.
So do you think it's a combination of the consumer and the retailer who are going to pull us out of this recession ultimately?
I don't think so. I mean, it'll definitely help, and retail is such a huge, or really consumer spending is such a huge part of the economy. We do need the consumers to spend, but I think it's going to be a number of factors that will help us out. But I do expect it's going to be a very gradual and slow recovery. As I said before, for a lot of people, once the recovery starts to take hold from a numerical basis, most people aren't going to feel like it's actually happened. They're not going to see the salaries being revised upwards. A lot of people are not going to be able to find new jobs or find jobs that are paying what their last job was giving them in terms of salary. So I think it's going to be a very slow and drawn out process. And for some consumers, they really needed to cut back on their spendings. They were just relying too much on credit cards, too much on home equity. Granted, there's some people who are in situations where they couldn't help themselves, but there's a lot of other people that just really needed to focus more on saving. And as a society, we do need to save more, but obviously the more consumers save versus spend, that just makes the recovery take that much longer to really take hold and drive the economy back to where it was pre-financial crisis.
All right, in this week's piece, text version of this piece that is, Charles outlines a couple of retailers that are showing some signs of growth, and you'll want to go to the text version at Zacks.com to check those names out for yourself. All you do is go to the home page and scroll down the page until you get to the industry rank headline, click on it, take you right to it. With Charles Rotblatt, I'm Terry Ruffalo.